Our next section is option strategies. Options are extremely flexible derivative securities, which allow them to be used for various investment purposes. This flexibility is achieved by applying option strategies, and in our course we're going to consider the most popular option strategies. The first that we'll look at is the purchase of naked long options. That is a purchase of either calls or puts only. It is the most aggressive strategy whose only purpose is to create leverage. It is also the riskiest strategy because if the market goes against the position, the total investment will be lost after the expiration date. However, if an investor has played the market correctly, the compensation makes the whole risk worth the effort. Now, here we have a profitability chart for both a long call and a long put. On the profitability chart, the dark blue center line represents the price of the underlying asset of the option contract, such as stock, at the date of expiration of the option contract. The dashed line represents the strike price or exercise price of our option contract. The light blue line represents either our loss or our profit. The point at which the dark blue and light blue lines cross is called the break-even point, or the break-even price. And this is the strike price of our option plus the premium of the option. Now let's look at an example of a purchase of naked long options. Let's say that the stock of XYZ costs $60 a share. We're going to purchase a January call 60 with a premium of $2, or a January put 60 with a premium of $2. So here's how it looks. Purchase the January call 60. We take the premium, which is $2, times the multiplier, which is 100, equaling the total cost of this position, $200. Or, for a put, we purchase a January put 60. 2 is the premium, times 100, the multiplier, equaling $200, the cost of the position. Now, as a note, the minus sign means money is spent for a purchase. And to simplify calculations, we're not including the commission fees and the margin required for a short sale. The next is a naked call right. This is another risky strategy which consists of writing or selling call options, which more often than not are deeply out of the money. The rationale behind using this strategy is that we believe the underlying asset won't increase to the point of crossing the strike price, thus leaving the option worthless at the time of expiration. The profit is made by keeping the premium we'd received by opening the position. Now for our example. XYZ stock is at 60. We have a January call 60 with a premium of $3. So we create the position like this. Sell the January call 60. Premium times the multiplier, equaling the position cost, which is actually credit, of $300. The next is a covered call right. This strategy consists in writing calls against the stock already contained in the investor's portfolio. The strategy is applied in the event that the investor expects a temporary falling or stagnation of the stock's price. This method allows the investor to keep the stock in their portfolio and receive additional profit through the premiums that come from writing the calls. The advantage of a covered call right versus a naked call right is, were the buyer of the written call to exercise their option to take possession of the underlying asset, rather than having to purchase the stock on the open market, creating an additional cost and risk of loss, simply the stock in the portfolio is delivered. Now our example. XYZ stock is at 60. There's a January call with a strike of 65 and a premium of $2. So the position looks like this. Purchase 100 shares of XYZ. Sell a January call 65. So the position cost is $5,800. The next is a protective put. This is a pure hedge strategy. The premium paid for a protective put can be regarded as an insurance policy. The reverse can also hold true for what is called a protective call. This hedges a short position in the event that you have already sold stock short. Now our example. XYZ stock is at 70. We have a January put 70 with a premium of $1. So the position, purchase 100 shares of XYZ, purchase a January put 70. Position cost, $7,100. The next is a straddle. This strategy consists of the simultaneous purchase of calls and puts with identical strike prices. This strategy is used in the event that the investor expects a sharp change in the price of the asset. However, they are not sure in what direction this change will be realized. Such situations frequently arise on the eve of significant events, for example, expected mergers of companies or takeovers of one company by another. Our example, XYZ stock at 65. We have a January call 65 with a premium of $2 and a January put 65 with a premium of $2. So the strategy is formed like this. Purchase a January call 65, purchase a January put 65. Position cost, $400. Our next is a strangle. This strategy is similar to the straddle, wherein a call and put are purchased simultaneously. However, with the strangle, the put is purchased with a lower strike price than that of the call. Our example. XYZ stock is at 65. We have a January call with a strike of 70 and a premium of $1, and a January put with a strike of 60 and a premium of $1. So the position looks like this. Purchase a January call 70, purchase a January put 60. Position cost, $200. Our next is a straddle and combination selling. This is a strategy used by an investor that believes the market will remain relatively unchanged for the life of the option. Through this strategy, the investor will receive a profit arising out of two premiums, one for the sale of the call and the other from the sale of the put. Now let's look at our example. Again, we have XYZ stock at $65. Our options contracts look like this. So we create the position. In the case of the short straddle, we sell a January call with a strike of 65, and we sell a January put with a strike of 65. We take the premium times the multiplier, and the premium times the multiplier, giving us a cost of that position of $600, and that's actually a credit. The next, the short strangle, we sell a January put 60, sell January call 70. Premiums times the multipliers, and then add them both together, and another credit of $200.